Hello, and thank you for listening to our third quarter investment commentary. I'm Angela Palacios, the Center's Director of Investments. You will also be hearing from Nick Boguth, our Senior Portfolio Manager. This year has been off to a very strong start as the melt-up continues. Even during what is usually the worst performing month on average, September, markets rallied. Mega-cap U.S. tech stocks have remained a standout this year again and have driven a lot of the returns for the S&P 500, at least for the first half of the year. But since then, we've seen participation from other areas of the market, which has been exciting, like international, emerging markets, and small company stocks. Bonds have been positive by about the interest they've paid this year, and the Federal Reserve has started to cut interest rates with a 0.5% cut in September. Interest rate expectations and inflation news have really been the major drivers of returns so far this year. You may have noticed that I left the election out of this list because the election hasn't really driven volatility so far. If you want to learn more about the relationship between elections and markets, you can check out a replay of our webinar last month. As we approach Election Day, though, the headlines may drive some short-term volatility, and certainly our emotions, but thankfully long-term markets are driven far more by factors like economic growth, Federal Reserve direction, and fundamentals like growth and valuation. It's very likely that the outcome of the election won't be settled by the time we wake up the day after the election, so this could cause some short-term volatility, but we wouldn't expect this to be sustained. So let's turn our discussion over to the economy. As you can see from this chart, the Federal Reserve seems to be engineering the soft landing they were hoping to. Inflation and wages continue to come down. Unemployment has grown slowly this year. Retail sales have slowed a bit, and GDP shows a slowing in this chart too, but has since had somewhat stronger readings as the year has gone on.
It's a great summary, Angie. So, the Fed is navigating the elusive soft landing as it shifts to this rate cut cycle. But that doesn't mean inflation is completely out of the picture. They'll have their eye on both sides of their dual mandate, unemployment and inflation. And this quarter gave us some examples why. Things like strikes on U.S. ports, OPEC oil announcements, presidential policies over tariffs and stimulus and immigration, all of these things can have an impact on inflation going forward. The economy is ever-changing, and headlines from this past quarter seem to give us a constant reminder of that fact. Another market headline that we had our eye on was the uninversion of the yield curve. After 2 years of an inverted yield curve between the 10-year and the 2-year yields, it uninverted last quarter, and that's totally normal. Many analysts point to the yield curve as a recession indicator, but what have stocks actually done in the past as the yield curve uninverted? 8 out of 10 times the S&P 500 was positive 1 year later. Headlines are written to grab attention, but we rely heavily on the actual data in our investment process.
So what does this mean for your portfolio? After this first rate cut by the Fed, the yield curve uninverted, and it's looking like the Fed has successfully engineered that soft landing. History can be a useful guide to understand how different assets beyond just U.S. large cap performed in this time period. Typically, you see risk assets doing well for equities, while in fixed income quality tends to shine. Certain asset classes may have a little more tailwind behind them because of starting valuations and a scenario layered in where we've had high but falling inflation. So while the outcome may rhyme, it probably won't be identical to this chart. Emerging markets have made some noteworthy moves recently. China has some significant developments causing them to play a bit of catch-up recently. Chinese leaders announced several monetary policy initiatives that drove their recent equity return spike. First was a 50 basis point cut to the reserve requirements. That's the amount of cash that the banks must hold in reserve against deposit. Second, they cut existing mortgage loan interest rates by 50 basis points. There were also other initiatives put into place to try to kickstart their economy. While the path forward could be bumpy, several factors remain a potential tailwind for emerging markets, like reasonable valuations, company fundamentals, as well as easing monetary policy.
One more noteworthy asset class from last quarter was small cap stocks, represented by the Russell 2000 index. Back in July, there was a huge move in the asset class as investors shifted their expectations to the rate cut cycle that we entered. These smaller companies tend to be more sensitive to interest rate moves, and this was a welcome moment of outperformance after years of underperformance from that space. So that is what we had our eye on last quarter, but most of us are investing with an eye years, maybe even decades into the future. No one can predict what each quarter will bring in the economy. The only thing we can predict is that each quarter will be unpredictable. So a properly allocated portfolio and enough cash to fund short-term needs is key. At the center, we strive to build a financial plan for you that will succeed no matter what headlines come next quarter. If you need help determining if your plan and your investment portfolio are appropriate, we're here to help. Thanks.